Hello, everyone, and welcome to today's class on fundamentals, concepts of financial management. I hope all of you are doing very well. So I'm going to start off today's lecture by talking a little bit about, what to expect in this course. So the main emphasis of this course and what the course aims to explain to you is how a manager can increase the value of a firm. So by the end of your financial management course, you should have a good idea about this. But before we go into exactly what managers can do to increase the value of firms, you will need to really get some basic fundamental understanding of finance topics. And these topics include time value of money, financial statements, risk analysis. We'll be doing some stock valuation. So that we will be covering quite a few of the basic fundamental finance topics. And once we've covered that, we will be learning, how using various tools, how any manager can increase the value of a firm. So next, I'm going to talk to you a little bit about what a successful company is. Now, if we look at, if we think of any major successful company, be it global or local, one of the main things that differentiate that company from all the other companies is that it is being able to create and deliver a product that is very highly valued by customers, and customers want to buy the product that from that particular company, from that particular successful company as compared to any other company. So again, the key factor that differentiates a successful company from an unsuccessful company is identifying, creating, and delivering products of value. So that's really, really important. So that's the first thing. What you can think of, one of the big, if we think of even tech companies and we think of Google, well, Google is offering a very highly valued service, right? It offers a service engine. If we think of Apple, it is providing an iPhone, or Samsung, a smartphone that is really good. And once people really start enjoying using it, they choose to continuously go back to, let's say, Samsung and buy their smartphones from Samsung. And the reason is that they're very satisfied with the product, and they value the product. They think it's better than anything else available in the market. Secondly, successful companies sell products at prices high enough to cover costs and compensate owners and creditors for exposure. So look, I mean, the customers want to be able to buy a very good product at a low price. So the whole objective is that, companies need to keep their prices just high enough to cover their costs. And again, it's the key people need to be given a salary, and you need to pay your bills. So, companies need to cover all their costs. But also, companies don't want to charge too much, because then their prices are going to go up and customers may choose to go to another company. So the whole idea is to keep very lean, efficient, companies, have them operate very, keep the productivity very high and cut out all the wastage, so that you can cover all your costs and still give a price for your products that's very competitive in the market. So that's the second thing. If there's a company, on the other hand, just to give you paint a different picture, let's say they have a very good product, but unfortunately, they're selling it at a low price and they're not being able to cover their costs and even pay their bills, then that company is not considered successful and it will go out of business. So they have to be looking after, themselves and their own needs, the company's own needs, such as their costs and, being able to function. And at the same time, they need to really be providing value to the end customer. Now, interestingly, if according to the business education and academia, successful companies basically have three main factors. The first thing is they have skilled people. Second, they have strong external relationships. This could be, with their suppliers, with their customers, and they have sufficient capital. And so, when you're doing your MBAs or you're doing your BBAs and you're studying, in essence, you learn a lot about how to develop people, how to, recruit the best people in your company. That's, bringing in skilled people. That's one of the things you learn about. The second is, managing your relationships and developing strong relationships. Nowadays, in the past, suppliers were seen as an anti-party, but nowadays, suppliers are seen as partners. So it's very important to develop, strong external relationships. This also includes a little bit of marketing and sales, because or in marketing and sales, you're also developing relationships with customers, and that's very important. And so again, you learn a lot about marketing and sales and all of these kind of things when you are doing your studying for your BBA or MBA. And finally, having sufficient capital, how to manage your cash flows, how to make sure that you can pay your bills, and that if you need additional capital to grow your business, what are your options? How can you go and get that money from the outside and in order to grow? So these are some of the factors that are considered important for any company to be a successful company. And it's important to know these things. And also when you're doing your business education, and when you're doing you're thinking about, okay, well, what is the ideal company you want to work for? You will notice that automatically could be an FMCG, for example. If you think of Unilever or any of the big ones, the wonderful textile mills nowadays in Pakistan doing fantastic work. Recently, I was reading about Service, a global footwear, and they are exporting to Zara's and all of these places. But long story short, the companies that you would want to affiliate yourself with, you will notice they generally recruit the best talent from the market. They have excellent reputation, strong external relationships, and they always have enough capital to grow. They have very good reputation in the finance sector. So for them, if they want to get a loan or anything of the sorts, it's easy for them to do so. So very important to sort of keep these factors in mind and know what a successful company is and what really differentiates it from others. Now, if we look at the a company's life cycle, if you look at a corporate life cycle or any company, any large company's life cycle, we will see that usually a company starts off small. Usually it starts off by, one person, and eventually it grows to a smaller size, and then, a medium size, and then it becomes a full-fledged corporation. In some cases, it becomes a big global corporation. But generally, we'll see that, there are about 4 steps for a company, especially for these very large global conglomerates and these big companies. They all go through 4 various steps to reach their ultimate large size. And I'm going to be talking to you a little bit about each one of these steps that a company goes through in its life cycle. So we'll start off with proprietorship. Now, generally speaking, as I just mentioned, companies start off small, and many times people started from their own homes. They start small businesses. We hear of stories where people started their business sitting in their apartment, in a small, apartment somewhere in a remote area of the world, and then all of a sudden, it starts doing well. So when companies, start off small, right in the beginning, the first step, that small, when they're in that very small, humble beginning stage, that is called a proprietorship. And generally speaking, such companies do need to get some sort of a license to start working. And the whole idea is the governments in general would like to know, okay, this is a business, and so that is operational. Right in the beginning, generally speaking, in any country in the world, small businesses are not subject to taxation. So that's not really needed. And it's generally very easy and inexpensive to start a small business. I mean, any of us can really start a small business online nowadays. And we see that, right? We see a lot of small vendors starting their businesses because it's easy, it's inexpensive. You just need a free social media site many times and a product that you can post photographs. People are interested. You're in business, and so that's great. Also, you really don't have to pay tax, or there aren't any regulations that you need to comply with and all of that. However, for small businesses, there are some very unique challenges. One of them is it's very difficult to get capital for growth. Many times you see small businesses, they struggle because they have very limited resources, and within those resources, they can only do so much. So they have trouble sometimes getting access to capital to grow. Also, if for any reason the small business owner ends up getting a lot of debt, let's say somebody owes them, somebody says, okay, we'll take all of your inventory, and they owe them money, but they are unable to. The person who promised to pay them doesn't pay them. Well, they are stuck with that situation. They are stuck with all of the business debt, and it becomes a personal liability. So that's a bit of a risk when you're doing business. And also, finally, the life of the business is limited to the life of the founder. When the founder passes away, then there's many times there's nobody to really replace the founder of the business. And so the business dies, it dies a natural death. So there are, as we can see, some big benefits of being a small business, but then there are also some disadvantages. So generally speaking, when a business starts doing very well, a small business, it starts doing well, the next step that happens is that business owners choose to get into a partnership. And so a partnership is basically when two or more parties associate to conduct non-corporate business for profit. And the reason it says non-corporate businesses because corporations are different, and we will look at that a little bit in the next couple of slides. But again, a partnership is basically when two or more people decide, hey, let's work together to grow the business. And this is a better situation because what happens is that now the risk is shared between the partners. So if there's any sort of a risk of people not paying, people who owed money not paying the business the money, well, this is a problem that can be shared. The debt can be shared amongst the partners. Also, what happens is sometimes partners, because they're very nervous about the situation, when they do enter a partnership, they decide to establish a limited partnership. And in this situation, one of the partners can say, look, I'm bringing in, let's say, a lot of creativity, ideas, contacts, but I don't have a lot of money. So I want to come into a limited partnership. That basically means that if, for example, the debt is 50,000 and you say I'm in a limited partnership for just 10,000, that's as much as I can offer in case, there's a huge business debt, then you, as part of the limited partnership agreement, only have to pay 10,000. You're not liable to pay more than that. And so obviously the other partner, known as the general partner, will be paying the remaining 40,000. So this is a way to really cap the amount of debt that you are liable for in case the company runs into some sort of a huge debt situation. That's a little bit about partnerships, but now let's talk about what happens if the partnership goes very well, but the business continues to grow and there is more need for money and expansion. So what are the options in that case? Well, in case a partnership continues to grow and the demand for, let's say, the product that the partnership is selling continues to really expand, and more money is needed, maybe another factory expansion is required, or some sort of huge, maybe a lot more employees need to be hired. Well, then in that case, a partnership has an option to convert itself into a corporation. And if you do enter a corporation and you just choose to become a corporation, it does have certain advantages and disadvantages. So let's talk a little bit about each one. So in terms of advantages, a corporation, it has an unlimited life. So even if let's say the partners pass away for some reason, well, the company will continue. Okay. Also, it's easy to transfer the ownership interest. So what happens generally is that the ownership, the basically the owners, the ownership of the company is divided into shares. So rather than just the partners owning the company, shares are sold in an open market, and people who buy the shares are then become the owners of the company. So it's easy to do that. If you have a corporation, it's easier to sort of sell shares for your organization in an open market. Also, there is a limited liability. If somebody has invested, let's say 100,000, they only are liable to pay up to 100,000 in case the company runs into a huge debt. So it's not like if the company ends up making a huge debt, then one or two people are responsible for paying all of the debt. So it doesn't really work that way. So again, there's limited liability, which is more comforting for many people, especially the owners and all at the top. Now, there are some disadvantages to having a large corporation. And the first disadvantage is that corporate earnings are many times subject to double taxation. So what happens is, there's just the way taxes are based on your profit. And every country has a different tax structure, but you have to pay the basic tax on your company. That's at one level. But also, if you pay out dividends and you decide to give back some money to your shareholders, then in that case, that money is also taxed. So this is a double taxation that does impact corporations. Also, if you do decide to set up a corporation, there is a lot of legal paperwork, and that's very complex and time consuming. So again, if you can see with corporations, there are some positives and some negatives. Now, when, let's say, a corporate also becomes very, very large, and they may decide to do an initial public offering. So in the past case, in the corporation's case, there was this thing, a decision of let's say, friends and family could be given shares, right? But what can happen in the case of, a situation where a corporate becomes really, really large, and let's say the company wants to expand and wants a lot of money. And again, one of the stories I just read a couple of days ago was about the Service Global Footwear company. That is a Pakistani company, and they are planning to do a $10 million IPO, which is an initial public offering. Now, what does that mean? That basically means that this company wants to expand and beyond its friends and families and all of that, and they want to now get a lot of money, and they are ready to sell their company stock to outsiders. And this again, this could be, they could continue to sell those stocks to their own friends and family, but also they can go also to various banks and they can say, hey, why don't you help us? You can buy some, you can. So the way an IPO works is banks get involved. And generally speaking, banks, they are very risk averse. They're very careful when they're, as far as investment goes. For example, if you go to a bank and any company wants to take a loan, they have to usually give assets, the paper for their assets worth the same amount. So for example, if I go to a bank and I say, I want a 10 million rupee loan, the bank will come to me, and let's say I'm a corporation and I go and I say that a 10 million rupee loan is what I want. They're going to say, okay, fine, you can get that 10 million rupee loan from us in cash, but can you give us legal documents of assets worth 10 million? And they hold on to those assets until I'm using those 10 million. Once I pay the money back, then I can get my documents back. So generally speaking, banks don't like to invest themselves and buy shares and so on and so forth. However, in the case of an IPO, banks do get involved. Generally speaking, the way an initial public offering works is that shares are sold to the public. So it's not that the company, no corporation can do this directly. Banks get involved. So the shares are first sold to the bank, and then the bank then goes ahead and sells it to the general public. And so this is basically the main activity that happens. And so the company then has, it's a very big event to have an IPO. But then, your company changes. It is now a public company. You now have, your shareholders are now public. In a corporation, you could still sort of, decide, okay, maybe you don't want to give it to public, limit it to friends and family. But here, when you do an IPO, you are now a public company. Once the IPO is finished, then your company shares will be sold in a secondary market on any stock exchange. So then, you see, like, for example, shares are being sold. There are some shares that have a higher price one day, a lower price the next day. All of that is happening because people are buying shares of the company, of a public company. So these are all things to really keep in mind, and just to really understand on a high level. IPOs are done are sold. When an IPO is being sold, it is known as being sold in a primary market. But when shares are being, shares that have already been sold to the public, when they are being transferred from one person to another, shares are being sold and bought by other people, that is known to be being done on a secondary market. And I'll talk to you a little bit more about that in a couple of slides down. Now, as companies grow, there are several problems that, unique problems that come up. And one of those big problems is known as an agency problem. And I'm going to talk to you a little bit about this and how companies, I'm also going to talk to you a little bit about how companies deal with it. So what an agency problem is, basically, it is when there is a conflict of interest. And this conflict of interest is, it could be between, the company's shareholders and let's say the managers, right? And there are also, it could be between, there's some other agency problems, but let me start with that one first. Now, if there is a conflict of interest, shareholders want that the managers are working in order to maximize the company's profit so that the shareholders can benefit. Many times, however, managers start taking decisions and start working Instead of thinking about, the shareholders' interest, they start thinking about their own interest, and they start making a lot of business decisions that are, in their own interest as compared to the company's welfare or and that or profitability that will help the shareholders interest. So when there's a conflict of interest between, let's say, shareholders and managers, this is an area of a problem. This is a problem area. And look, it's very difficult for companies to constantly be, for the shareholders to constantly be micromanaging. I mean, that and in checking everything that a manager does, it's very, very difficult to do that. And so, in order to control that situation, there are a lot of corporate governance laws that companies have, and that basically helps control, companies, managers' behaviors and stakeholders' behaviors across the organization. So yeah, I mean, this is definitely a challenge, but having the right rules and regulations throughout the organization helps control it. So again, as I was just mentioning, what happens, if there is a company and you sort of see that managers are like making, decisions that are in their own favor versus the company's favor. For example, let's say they start just using vendors that are family, or their friends, and versus going in the open market and really, finding the best vendors at the lowest cost. So in a case like that, let's talk a little bit about what are the corporate governance rules that can really protect the shareholders. What can be done to stop managers behaving that way? Well, first of all, there's a lot of technology nowadays. So there's a lot, it's becoming a lot more easier to see what's going on. A lot of companies are investing in ERPs, which are big computer, like SAP. You must have heard about these kind of ERP, enterprise resource planning software. And so through this software, even senior management can see exactly what's going on. It's becoming a lot more transparent. But additionally, look, there's always the whole idea of making sure that managers realize that they can be fired. Also, linking many times the compensation, instead of giving, let's say, a salary, giving employees or managers a bonus for if the profits go up, or making them, giving them shareholder shares in your company. These are different ways of really making the manager feel that, look, if the company's shares go up, the profitability goes up, then even they can benefit. So if they're just on a salary, they will not feel the desire necessarily to, they may start looking out for their own interests. So these are some of the ways. There's also the whole idea of direct intervention of shareholders. Many times what happens is very senior people decide to be involved in the day-to-day management and not just leave it to managers, because they feel that if it was left, then this agency risk may really take its toll. I'm going to talk to you about another kind of agency risk in the next slide now. So another kind of agency risk is shareholder versus creditor. What happens is many times managers may decide to take very, very risky decisions. And they may decide that, say, for example, to get into 5 new businesses altogether. Now, this may, it may basically help the stock price increase, because the news in the market will go that, oh, hey, you know what? There's a whole lot of activity happening in this company. They're entering new businesses. So now the shareholder value may start going up. But what happens is that the company may have to go out to the various banks and take on a lot of loan, and it may eventually become very difficult to pay off that loan. So this, because of this, what may happen is that the banks will say, okay, look, you're about to enter these 5 very risky businesses. We will give you the money because you are a well-known company, but we are going to give it to you at a higher interest rate. Now, if the interest rate is very high, then the cost for the company goes up, and eventually this will lead to lower profitability, and eventually will lead to a lower stock price as well. So again, this is a different kind of agency risk where, in one case, the shareholder value may be going up initially, but also the price you're paying to take on credit from the market is also going to go up. So this is another type of risk. And again, you really need to, in this case as well, the main thing is to really keep an eye on managers' decision making, and also monitoring, what's happening from a risk perspective, and how much of a risk appetite does the company have, and when is the right time to take on risk. Now, right at the beginning of this lecture, I spoke to you about increasing the value of a company and how that should be the main objective of any organization, any corporation. If we talk about specifically corporations, and we sort of see people that own shares of a corporation, the reason that people end up buying shares of a corporation is because they want to be able to make money. This is an investment in an organization, and they feel that rather than having to start their own business, they are taking on a little bit of risk, but they hope and they think that this is going to be very beneficial, and that they are going to be able to make a profit. And so that's the whole reason that they are buying stock. They really believe that the stock price will increase, and they're going to be able to make profit without taking on too much risk. The management of any company, their main objective should be to really increase and maximize the stockholders' wealth. And how is that going to happen? That's going to happen with increased profits, because the profits are then going to be shared amongst the shareholders. Now, in the market, there is a market price of any stock. And if you look at the Pakistan Stock Exchange, for example, or if you look at any global stock exchange, daily there is a market price of stock. And this is based on the information that is made public to investors. So let's say, for example, the company is facing some sort of a problem. There is some sort of factory related problem, and this information becomes public. Well, what happens as a result is the stock price you will see a dip. On the other hand, let's say the company has been doing very well and they are in an expansion phase. Well, if that is then this news is made public, the stock price will go up. Now, the thing is, however, that all this information that is made public is at the discretion of a company. Company decides what information they want to make public and what they want to keep private. This is basically makes it a very tricky situation, because it is, just looking at the stock price of a company, you can't really tell how well or how bad a company is doing, because not all of the information is disclosed, and therefore to the public, and therefore the public sentiment that is dictating the market price of stocks is not really the final metric to look at. Instead, companies should focus on maximizing the fundamental price of the firm's common stock. And this basically means keeping all the information, everything in mind, with full disclosure. The intrinsic value of the stock is what they should really be focusing on improving. So keeping everything in mind, they should try to really improve their profits so that the shareholders, our wealth is maximized. That is what the ultimate objective should be of a management of any corporation. So a lot of people may argue that really, I mean, should just the end objective of every company just be profit maximization? Is that a very greedy approach? Is that something that is ethically correct? If companies are just focusing on improving, the shareholders' wealth, then is that, what about society as a whole? Is that good or bad for overall, society and social welfare? Well, the first thing is that, there's one big caveat that management of any company should be looking to maximize shareholders' wealth, but it should be being done in an ethical way. If there are unethical practices, then that is bad news, and there is, sooner or later the company will go get into some sort of trouble. So that's the first thing to keep in mind. Ethics are very, very important. Now, if according to the author, Eugene Bringham's, Eugene Brigham says, look, think about it this way. If a company is going to be doing well, let's say it's a corporation, and or there's been an IPO, and there's public stock in the market. Well, in that case, the owners of that company are not just the original owners, but it's the general public, a huge portion of society. So if the company does well, then a big portion of society is also going to benefit from it. Secondly, according to Eugene Brigham, he says, look, if a company is doing well, then you really need to realize that they are bringing some sort of a good quality product to the market. Could be a good quality product or service, and they're being able to do it at the lowest possible price, at a very competitive price. So overall, society is benefiting because better products are coming into the market and at very competitive prices. Finally, Mr. Brigham says employees benefit because, look, the thing is, if a company is growing, if a company is doing well, that means that they are going to be hiring more people, and employees are going to, if as the company does better, they may be getting more bonuses, they may be getting more salary increases. And so employees are going to benefit. And again, socially, also there will be social welfare that is going to be created through the maximization of shareholder wealth. So in terms of value of a company and all of these things, I'm now going to start telling you a little bit, from a finance perspective, how is it measured? What are the things to keep in mind? And especially in the next couple of lectures, we'll be really trying to figure out the values of shareholder value and all of these things. But just to give you a primer and to start, give you a basic introduction. Companies, when you're trying to understand the value, you're trying to figure out, the value of a company, that the first step is you have to look at their cash flows, their current cash flows and future cash flows. And when you look at these cash flows, then you basically eventually after calculating the cash flows, you are able to take a couple of other steps, and then you determine the value of a firm. Now, there are a few things to keep in mind. First is, any financial asset is as valuable as the funds it is able to generate. So, this is one thing to keep in mind. Secondly, timing of cash flows matter. In finance, it is one of the key things to remember is a dollar that you can get today is more valuable than a dollar that you'll be able to get tomorrow or day after, or the day after that. So cash received sooner is always better. Finally, another thing to keep in mind is that investors are always averse to risk. No investor wants to really take on any additional risk. So what that means is that in order to, if you are in the process of wanting to increase the value of a company, what you should be aiming as a manager should be to, number one, increase the company's cash flows, increase the speed of receipt of the money coming in to the company. Try and make sure that if somebody owes you money, that's coming in sooner rather than later, and try and take steps to really decrease the amount of risk that the company is taking. Because generally speaking, if a company is taking on too much risk, shareholders get nervous, and that's not a good situation. So you have to take calculated risks, and slow and steady. So if in terms of cash flows, well, what cash flows should the management really be looking to improve and increase? In finance, we will be looking at something called free cash flows. So management should be focusing on increasing the free cash flows. That's the metric that they want to keep their eye on. And we'll be going into free cash flows, how to calculate them. But just to give you a quick overview of what a free cash flow, the formula for that is sales revenues minus operating costs, minus operating taxes, minus required investment in operating capital. One of the things that we will also be talking about is something known as WACC, which is the weighted average cost of capital. And just to, this is just an introduction, so I don't want you to get worried about any of this, because we'll be learning about all of this in depth. But weighted average cost of capital is the rate of return required by investors. So if investors are investing in your company, they do require, have some sort of expectations in terms of the rate of return that they want, and that is known as WACC. Now, next I want to talk to you about something called the capital allocation process. And capital allocation process is basically transfer of capital between savers and those who need capital. And this can happen in 3 different ways. So again, if there is a let's say a corporation and they are in need of more money, they, for any reason, they are either looking for expansion or they're running into some sort of a cash crunch. There's 3 basic ways that they can get more money immediately into their company. The first one is a direct transfer. And so they can basically go to shareholder. They can go and talk to their current shareholders and say, look, we need money. Can we give you some more shares of the company? We'll sell you more shares. Can you give us some money? So these could be friends, families. Let's say if they haven't gone public, this just maybe a smaller group of people, and they go to them and they say, hey, we need more money. Can you do that? And those friends and families say, sure, we'll buy your more of your stock, and so it works out that way. So this is a quick way of doing it. Another way is to go through a bank, and in this case, this is basically an IPO kind of a situation, an initial public offering. And here in this diagram, right over here, you can see what happens is the business sells its shares to an investment bank, and the investment bank then goes to the public and sells those shares. And money is given initially when the business says, hey, we want to get into an IPO. The investment bank says, sure, we will buy all the stock. So the bank gives them the money. But once the investment bank goes and makes an IPO in the primary market, they are able to sell to the public as they are able to float the IPO and sell it to the public, and then they also get money in the middle. So basically here in this situation, again, the business is able to generate a significant amount of money through doing an IPO. The final way is known as the indirect transfer through financial intermediary. And in this situation, it's a little bit different. This can be done by banks. It can be done by mutual funds as well. So basically here you have some sort of a financial intermediary in the middle. And so they say, okay, we are going to buy, the business says, look, we need money. So they go to this, either could be a bank or mutual fund, and the bank says, fine, we will buy your stock and we will pay you money. So they go ahead and they do that. And then the bank holds on to that stock of the company. And instead, the bank basically has its own intermediary security that they go into the public to sell because they need money also, right? So they basically sell their own securities. Could be some sort of financial instrument that they sell. It could be a bond of some sort. They generate money from the public, and so they have enough money to pay the business. But they want to hold on to that stock, and maybe they do that because they think that the stock value may go up and they can get huge profit windfall. So that's why they do that. So next I want to talk to you about financial securities and the cost of money. So what is a security? What is this stock or this bond? What is it? Well, really, these are pieces of paper and they have a contractual provision on it. It basically is a claim. So if you have a bond, for example, you can claim that, look, this is the amount of money that I paid, and there's a certain amount of, let's say, interest rate that I need to get, and then if this bond, I can cash it in on a specific date and time. So there's always, for any bond or any security per se, there's a time to maturity. And also there are different types. There could be a debt security, an equity security, or also something known as derivatives. And I'm not going to go too much into derivatives, but derivatives are basically security whose values are derived from values of some other traded asset. And I'll talk to you about this at a later date and time. But these are just to let you know, there are three kinds of financial securities. And again, pieces of paper, and it basically gives you a right over certain cash flows in the future. Okay. Now, securities can be sold. There are short-term securities and there are long-term securities. Short-term securities are known as money market securities, and these are securities that mature in less than a year. So they could be 9 months, 8 months, something like that. And then on the other hand, there are securities that mature in more than a year, and those are known as capital market securities. So if you own a bond, as I just mentioned, that is a debt type of a security. And in that case, you will be getting some sort of an interest rate. So on the bond, it will mention an interest rate. On the other hand, if you're owning a shareholder or some sort of share in a company, that basically means that it will be mentioned over there that you will be entitled to dividends that the company issues, and also any capital gains. So that the stockholders, will eventually get. So these are two kinds of things that you will be entitled to if you own any share. And just to clarify, a capital gain, what that means is that, look, you will get money for dividends, but then if you decide to sell the stock and it is being sold at a higher price, then you will be able to get a profit. So these are the two kinds of, cash flows that you are looking forward to if you end up buying some sort of a share. Okay. All right. Now, there are several things that really impact the cost of money. So, for example, let's say, if people want to buy bonds or stocks, I mean, there are certain things that really impact their decision. And let's talk about a couple of things. The first one is production opportunities. So these are the future benefits that can be derived from capital. So let's say somebody has invested in bonds, and all of a sudden they have a huge interest rate. And so they feel that, look, this is great because a year from today, once this bond matures, and while it's maturing, I'll be able to earn so much interest. And so this is something, then once with that money, I can then do XYZ things. So this is something that impacts whether or not people want to buy a bond. Similarly, for a share in a company, again, a lot depends on how much people think that the shareholder stock market prices are going to increase. This impacts whether or not people want to buy it. Another thing is the time preference of consumption. Now, some people they need money fast, and other people, they are long-term investors. They don't need the money as soon. And so really a lot, the cost of money and whether people are buying or not buying securities, financial securities, a lot also depends on the time preference for consumption. If, for example, there is a security that's floated, and it said that you have to lock in for 100 years, then most people may choose not to do that, because in 100 years, probably none of us are going to be, a lot of us may not be around. So in that case, people may not choose not to go in for something, that long term. So these are things to keep in mind. The next thing is risk. So what is the risk that, let's say, the company will go bankrupt or just out of business? Obviously, nobody wants to invest their money in such a risky proposition. So this is something to keep in mind, and also inflation. So let's say you're getting a 5% return, but the inflation is increasing at 50%. 5% is not going to be worth very much, because the inflation is increasing so much. So the value of that 5% return is going to be very little. So these are factors that really impact the cost of money, and they're very important to keep in mind when, let's say, governments or other people are interested in, floating some financial securities. These are things that they keep in mind when developing the financial securities and selling them to the market. There are also a lot of economic conditions that impact the effect and the impact and the effect the cost of money. So, what's happening in the country? What's happening to the exchange rate? What's happening? Is there a lot of, if, let's say, for example, there is some security risk in a country, well, then people don't want to necessarily invest there. Is the country running into a trade deficit, or is there a trade surplus? If there is a deficit, generally there's going to be higher interest rates in that particular country. Is there a recession, or is the country in a growth phase? In recessions, generally the inflation rate and interest rates, they go down. Again, if there is a deficit in a country, there's a budget deficit, then interest rates will probably increase. Again, there's also the Federal Reserve policy. And according to this, if money supply increases, then interest rate decreases and inflation may increase. So there's so many economic factors as well that impact the, cost of money, and impact whether, the public sentiment about, whether or not they want to invest in financial securities and how much. Finally, as I'm wrapping up this lecture now, I wanted to talk to you just a couple of terminologies. I did mention this, through earlier in the lecture as well. A primary market is when a stock is offered for the first time, an IPO is being done, first time a company is going private. That transaction is known to be done in a primary market. Once the stocks are sold in the primary market, after that, when investors decide to buy and sell securities, that is done on stock exchanges, and those are known as a secondary stock market. Also, just a little bit about financial, markets. If there is an asset that is being bought or sold in the spot market, that means it's being bought and sold right then and there. On the other hand, if something is being sold in the futures market, that means that something is being bought today for delivery at some future date. So this is the difference between stock markets and futures markets. And with that, I come to the end of this lecture. I hope you enjoyed it. There was a lot of information that was sent your way. But this is all good introduction information for you. And after this, we'll be going into some very interesting topics on the time value of money and so on and so forth. So I look forward to the next lecture, and take good care. Thank you.